for the past couple of days, the market seeming to be gaining some momentum, at least the banking sector certainly looking upbeat. What have you made of the trade we've seen so far this week?
Thank you very much, Alishia. We think the market has actually been relatively stable this week. We've actually seen some gradual notch up, more of gradual notch up than down. So far, the market actually came down only on Tuesday. Subsequently, we actually been this market actually moving slightly higher. Week to date, I think we are up over 100 basis points so far. And of course, we've actually seen some level of confidence in the banking sector as a whole. Unlike last week and the previous preceding week, when we actually saw the banking sector actually losing significantly, we've actually seen some relative level of stability, and it seems as if investors' confidence is gradually returning back, especially for the banking stocks.
What's interesting, Olatunji, and what we've noticed is that we've started to see uncharacteristically large volumes being traded in small cap stocks like GoldLink Insurance. We've got Transcorp, Cornerstone Insurance, Unity Bank, and Custodian and Allied as well. What are you making of that, and where attention is being diverted right now?
I think, of course, if you look at the market generally, I think apart from the non-financials, we've actually seen some stability in the manufacturing and the fast-moving consumer goods sectors. The banks and the insurance companies have actually been suffering, and they've actually been lagging the other indices generally. And I think the reason wasn't far-fetched. A lot of people never really trusted what the banks and the insurance companies were carrying. But ever since the reforms that started with the banking sector, we've actually seen the banks actually declaring the assets that they were carrying at certain value which were not realistic. They've actually been marked to market, and I think that has also been going on in the insurance sector. So investors generally are seeing the true position and reality of what is going on ground for the financial services. And of course, some people have done their numbers and they are probably comfortable with what is going on. Of course, we've seen some institutions actually taking positions, especially in the insurance sector, over the past couple of trading sessions, and I think that accounts for the reason why we've seen the big volumes moving through that sector. If you look at the results that have been coming out in that sector as well, you notice that we've seen a lot of significant write-downs. The equities portion of the investments that they are carrying have actually been marked to market, just the same move we've actually seen the banks do. And of course, a lot of people have digested that, and I think the confidence is gradually coming back. They are seeing value at current levels for most of those insurance companies, and of course, they are taking positions.
Let's get specific here. I mean, if we look at WAPIC Insurance's result, 82.19% growth in companies' full year for 2008 gross earnings, but a 69.8% decline in profit after tax. And the primary reason being cited for that decline is stock market investments here. They expect, though, that for the full year of 2009, this company is going to make an attempt at actually increasing its profitability through investment returns from less risky assets. Is that shift happening away from the equities segment and into safer options?
I think prior to now, when the equities market was booming, I think to a large extent, some of them actually invested heavily in the equities market. I think what most of them would now do is go back to the drawing boards and do a better asset allocation, which you definitely see them doing. What portion should go to the equities, what should go to the bonds, and what should go to the real estate and other subsectors of investment that the banks they have actually, the insurance companies have actually been doing over time. Now, I think what's going to happen is that instead of allocating significant portion of their funds to equities, there are chances that the bond market and also the real estate might actually take a substantial portion of the investment. Now, and of course, if you look at it, if to a large extent they have done the mark to market that they were supposed to do, and they have reduce the equities that they were carrying, and it's reflecting the true position of things. I think the chances are that going forward, there could still be some write-backs at the end of the day. If you look at it, for example, for the non-banks or non-financial services, if you look at where they were from the beginning of the year, especially for the blue chips, where they were at the beginning of the year, and now you probably notice that there have been some write-backs. So if you're still carrying some of those stocks, the chances are that you could also still make some profits by writing writing back part of what you have actually written off earlier at the end of last financial year. So it's still a win-win scenario, whether they are doing the allocation again or they're still in equities. I think for as long as they've done the right thing, I think there's still chances that they would still make money at the end of the financial year if they have done the right downs at the last financial year.
Well, Olatunji, joining me in studio right now is Dexter Mahachi of Securities Africa. So we're going to be getting his perspective on the insurance sector. Dexter, thanks so much for joining us this morning. We've been putting some of these, the insurance sector largely under the spotlight, and we've already spoken about one possible shift that needs to be taken where insurance players shift their focus from equities to possibly less risky assets, making investments in that area. But another shift that has been so emphasized in the past has been the fact that these operations need to start focusing on their core business again, that of selling insurance. Your view on the insurance sector and shifts we're seeing in that space right now?
I think if I were to look at what has been happening in the insurance sector in Nigeria, I think the industry, if we look back at its track record over the past 5 years, has been in a state of flux. There's quite a lot that needs to be done on the legislative side to try and improve things. I think one thing you've already identified is the fact that they need to concentrate on core business. If you look at it, the number of sales agents that they have is simply not enough. I read a report the other day which actually pointed out that Nigeria has almost between 5,000 and 50,000 insurance agents there, and yet you look at an economy like Malaysia, they have over 300,000 insurance agency. I think if you look at that, that actually shows you that there aren't enough people out there selling insurance, and this is reflected in the fact that almost 94% of Nigeria is regarded as being almost 94% underinsured. And I think NICOM, the industry regulator, has been looking towards moving towards a 70% figure by 2012. I think the room for there are tremendous growth opportunities there for quite a lot of these insurance companies. But like you said, they need to get the figures straight. They need to sort out their claims ratios. They need to sit down and face some of the challenges that they currently have in the industry. One other challenge that might not have been mentioned a lot would be the fact that IDs in Nigeria are a bit of a problem. So you might tend to have instances of insurance fraud. I think one way around this is to go the way the banks have been doing, whereby they actually approach companies and try to insure people from a corporate sector. I think one company which has been doing that is Crusader Insurance, and also WAPIC as well, because that is a possible area where they can get quite a lot of growth from.
Well, certainly lots of opportunity that abounds and avails itself there with the fact that we've got such under-penetrated market that we're looking at. Just very, very quickly, Olatunji, we saw GT Assurance listing on the NSE yesterday. That share price moving up and really in line with the market movement we saw yesterday. Your view on GT Assurance very quickly.
GT Assurance, I think it's a subsidiary of GT Bank. And if you look at the contributions of the subsidiary to the parent company last year, I think it was still remarkable. It was still very okay. The earnings were still very in line with what the valuations are still looking like now. But the problem I foresee with GT Assurance right now is the fact that there are so many. Most of the insurance stocks are trading way below where GT Assurance is trading at the moment, and the chances are that because the market is not that liquid at the moment, the chances might be that it might eventually probably just hover around where it is trading at over the next couple of trading sessions. Until we see serious liquidity come into the market, I think GT Assurance just probably continue to trade around where it is. But we believe that the stock is fundamentally sound at current levels. It's doing pretty well. They've got good corporate governance. They've got quality earnings. They've got the management team to actually drive the business of the insurer. But then, like I said, liquidity might still be a major challenge for GT Assurance.
Certainly we'll be keeping an eye on that counter as we progress.